Welcome back, my friends. As you may have noticed, speculative investments are having a disastrous year. Cryptocurrency companies are going bankrupt. FTX declared bankruptcy just this past Friday. Values of cryptocurrencies are collapsing. Questions even arise about whether cryptocurrencies are actually worth anything at all. U.S. home prices are in the midst of a major correction. There seems to be some debate over whether this is just a correction or is it a collapse. Or, is it a slow-motion train wreck in which prices keep slowly trending downward for a long time? Not all areas are equally affected. But pandemic-era boomtowns and cities that attracted speculators are going to be particularly hard hit. Home builder confidence is collapsing. Zillow, Redfin, and Opendoor and other iBuyers are selling off their real estate portfolios as fast as they can. Prospective buyers are backing away from the market because they think prices have a lot further to fall. What does this mean for the real estate industry? What does it mean for the value of risk assets? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Some say the painful end of get rich quick thinking may be good for the economy. Speculators hoping to make a killing as cryptocurrencies got slammed this year. Cryptocurrency values briefly rebounded from this year's plunge in valuations. But, then one of the most trusted exchanges for crypto trading, FTX, filed for bankruptcy. Old-school financiers look askance at inexperienced crypto investors who they say should have known better. This year, there are new signs of a catastrophic decline in speculative investments in general. And this is part of a general trend that goes far beyond Bitcoin and other cryptocurrencies. A lot of so-called investments, like house prices and tech company valuations, look completely overvalued. That goes for so-called fintech innovations, including cryptocurrency, as well. These risk assets recently seem to be shooting for the moon. But they are now coming back down to earth. Many investors are getting burned as soaring speculative investments crater. Not just that, many people are saying that this trend will actually benefit the economy. Recent years of speculative investments have encouraged get-rich-quick speculation. Rising interest rates mean a return to the old-fashioned kind of investments. Real-world investments that use money and workers more efficiently to create real economic value. But on the other hand, the recent Bitcoin crash does not mean that the financial innovation of cryptocurrencies is over forever. Nor is housing. Nor is new technology and companies based on it. And social media companies such as Twitter. Meta's metaverse, while polarizing, is not innately bad or useless. But rising interest rates makes money tight. Many so-called investments that seem to be obvious winners are crashing. That is usually because the business model simply does not justify that optimism. A rising tide lifts all boats, to quote a familiar business saying. Only when the tide goes out do you know who's been swimming naked, said Warren Buffett, a longtime advocate of slow growth. But as central bankers raise interest rates, it is not just reckless speculators and mismanaged businesses that are suffering, said Lisa Forbes, a manager at Seed Winnipeg. Seed Winnipeg is a nonprofit that teaches and promotes business skills. It also helps to find loans for new entrepreneurs. Forbes thinks that rising interest rates are already hurting. These days, self-financing entrepreneurs are reluctant to leave safe jobs to start a riskier venture. The incredibly fast increase in interest rates is making it so that we've got people that are shy about wanting to get a loan, Forbes said. A business that never starts or is undercapitalized is ultimately unsuccessful. In the past decade, venture capital backers have preferred software as a service, SaaS, startups. But, the spate of high-profile business failures has some venture capitalists backing away. The fact is that the glut of capital in the past few years has resulted in too many companies in every market, said Nick Mehta, CEO of the software company Gainsight. Central bankers tend to focus on whether the economy is using its financial and human resources efficiently. Many economists have warned that low interest rates would create zombie companies and serve to prevent the self-renewing process of creative destruction. Cheap money can fuel entrepreneurialism. But some economists are saying that the cost of borrowing had recently become too low. This is especially true when interest rates are below the rate of inflation. In that type of situation, investors are able to make money doing things that added little value to the economy. But there is always extra cash sloshing around the globe looking to be put to productive use. This is especially true when the banking system in certain countries cannot be trusted. Then, the money comes to bid up the value of speculative assets. Or, more to the point, assets that would not be speculative at a lower price, but are speculative at a high price. That seems to be what has happened to the price of houses in the United States. After years of astronomical growth, home prices are now declining in most markets across the United States. But housing prices are still higher than they were at this time last year. Some experts expect a steeper downturn. Other experts say it is unlikely they will fall too steeply. The US is teetering on the brink of recession. That inflation continues to rage. And the Federal Reserve is aggressively raising interest rates to fight inflation. The pronounced rise in mortgage rates over the past several months has basically made housing more expensive buyers who need a mortgage. As a result, many buyers are pulling back. Sellers are mixed with some sellers eagerly and systematically lowering their asking price. Still, demand seems to be somewhat strong and that is supporting prices. There is a sharp turnaround the once red-hot, pandemic-driven housing boom. Markets seeing the largest declines are ones that are the priciest. San Jose, San Francisco, and Seattle. That makes sense because these markets were basically unaffordable to begin with. And with mortgage rates rising, they are becoming even more unaffordable. Among the other markets seeing big declines are the pandemic-fueled boomtowns: Boise, Denver, Salt Lake City, Phoenix, and Las Vegas. Many experts think that it is unlikely that home prices will fall dramatically. Some sellers refuse to sell for any amount less than what they believe their house to be worth. Many sellers can afford to wait. Others, including institutional holders and so-called iBuyers, do not want to wait. So they and other sellers will sell for whatever the market will give them right now. How far and how much prices will pull back? Well, nobody really knows at this point. US home prices are higher than they were in 2021. But prices seem to be declining every week as sellers get more desperate and buyers back away. The Federal Reserve has aggressively raised interest rates in 2022. This is in an all-out effort to stop what seems to be runaway inflation. These interest rate hikes have increased borrowing costs. Home builder sentiment is in a record collapse. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.